In this video, I'll be going through concepts and principles that we are discussing. I recommend that you review the videos that are posted in Connect, which relate to Part 1 of Chapter 10, as well as review the PowerPoints and text. So I'll cover many of those principles and topics as I discuss some of the assigned problems and exercises you have for this week. This is Chapter 10, Part 1. Next week, we'll finish Chapter 10 in our abbreviated week for Thanksgiving week. So the assignment will be a little less comprehensive next week, and we'll cover most of the details of Chapter 10 this week. So in the first problem that you'll face in Connect, this one relates to problem 10-1 in the text if you wanted to follow along. What I did, as I usually do, is change some of the data in the problem in the off-shaded cells. And this will allow you to learn the principles and then complete the Connect assignment as well. In problem 10-1, we have various situations for TriStar production. And these transactions occur during the first 4 months of its operations. So we just list the transactions. I just entered the data with some altered data, as I said. The first transaction was on September 1st. Acquired 5 acres of land with a building that will be used as a warehouse, so an income-producing asset. TriStar paid $100,000 cash for the property according to appraisals. The land had a value of $75,000 and the building had a fair value of $45,000, and I changed the 75 to 80. One of the first things I did before I completed the journal entries below is I allocated the total fair value of each of the components, land and building, proportionally. So we see that using my altered data, the land constitutes 64% of the total fair market value. Therefore, its 64% will be applied to the $100,000 when allocating the cost. And the 64% is derived by using my numbers again, the 80,000 into the sum of 80,000 plus 45,000. The 36%, I could have just taken 1 minus 64%, or as I did in this case, took the 45,000 and divided it by the sum of 80 plus 45,000. We'll need those percentages, as I said, to allocate the total cost of the combined purchase of 100,000, since it was less than the combined fair market value of 125,000. Moving to the second transaction, we have a $40,000 non-interest-bearing note to purchase equipment. The $40,000 payment is due September 1st, 2022. And we're going to assume an 8% interest rate. So again, I got down the data, changed the discount or interest rate. Transaction 3, we're donating a truck. That's going to be revenue. Number 4, we have lawyer's fees for organization costs. We'll talk about the journal entry for doing that. And number 5 was the purchase of maintenance equipment for cash. And we need to include, of course, the freight charges, which I have altered. Number 6, TriStar acquired office equipment. The company was short of cash and could not pay the $5,500 normal cash price. The supplier agreed to issue some shares in exchange for the missing value. So, with some changes to the cost of the land acquired, I entered the other data as listed in the problem, including the interest rate on the note for 1 year. So now how do we journalize these transactions? Okay, so let's go back to the first one. Here we had cash paid for a combination of land and building. So we have 2 new assets on the books, land and building. We know we paid cash of $100,000. And I just multiplied that $100,000 times the percentages I calculated earlier for each of the assets. For transaction number 2, the value of the note to purchase the equipment using my altered discount rate. Well, here's a case where we have a notes payable of $40,000. Because they tell us that a note was issued and due on September 1st of 2022 at 9%. We have to calculate then the value of the equipment. Since this is a non-interest-bearing note, we have to discount the value of the equipment. And we do that by using the time value of money formulas. So in this case, the rate is 9%. Number of periods is 1 year. And then we have the future value, the payment of $40,000. So we have to pay on the future date of $40,000. So what is that $40,000 worth today, discounted at 9%? It's worth $36,000 $36,697. So $36,697 is the value or the cost of the equipment on the books because it was financed with a non-interest-bearing note. The difference between the two, the $40,000 payable and the value of the equipment, will be the discount, this contra account. And this discount will eventually expense over time. But at least at the point of purchase, we're just going to take the difference between 40 and 36,697. Number 3, we have a truck that was donated to the corporation. Well, this represents revenue as a donated asset. And just fill in the values, and then we have the truck as a new asset. Again, feel free to stop and replay the video at any time to review some of the concepts and solutions I'm discussing. Number 4, we have organization expenses. And this was the lawyer fee of $3,000. So we paid cash of $3,000 for credit, and then we have the expensing for the income statement for the organization costs. Down to 5, purchased maintenance equipment, purchase price of $15,000. We have to add in the freight charges, as we said earlier. Transaction number 6, we acquired various office items. We have new office equipment brought in at its value of $5,700 using my altered data. We have common stock, no par, so it's just going to be a credit to the equity that's been issued for $5,700. This is not an uncommon practice for young startups that maybe don't have the cash to pay for some of the professional services that are needed to establish the company and get it up and running, so they offer them an ownership interest in the company. And then finally, number 7, the company acquired a tract of land, cost of $20,000. They paid $2,000 down and signed a 10% note. Principal interest due in a year. So in this case, what I did is we have the notes payable, and that's given to us. We have the cash paid given to us, and then the land will be the combination of the two. If we scroll up to 7, you'll notice that although I did change some of the data, one thing we have to remember is the amount financed for the land will be the total cost less the down payment. So the total value of the land acquired less the cash down payment, since that is not financed, leaves the amount to be financed, which is, in my case, $16,000. Moving on to exercise 1 in the text. And for those following along, in the text, it happens to be on page 552. Here we have Belden Corporation purchasing land as a factory site for $60,000. I changed that to $61,000. An old building on the property was demolished, and the construction began on a new building that was completed December 15, 2021. Costs incurred are listed below. So we have the demolition of the old site, raising of the building. We have architect's fees, legal fees, property taxes going forward, prospective, so those would not be capitalized in the cost of the asset. These would be expensed as they're incurred. So we would not include those. We have the construction costs themselves. We have interest on the loan. This interest on the loan is capitalized during the construction period. Once the construction is complete and the building is being used for its intended purposes, then those interest costs on that outstanding loan are expensed. But during the construction period, those interest costs are added into or capitalized into the cost of the property. In this case, after they're building a new building, those costs will be added to it. Selling price of salvage materials, that will offset some of the demolition costs of the old building. So they've demolished the old building. This $2,000 will offset some of those costs because they recovered a little bit in salvage materials that they could scrap. So what are the capitalized costs then of the two assets? Well, let's look at the land first. In the case of the land, we're going to add, of course, first the cost of the land. We'll add the demolition of the old building to the cost of the land. Remember that demolishing the old building is getting the land ready for its intended use. So that's added to or capitalized into the cost of the land. In addition to the cost of the land and demolition of the building, we're going to also add in the legal fees for investigation of the land. Finally, we're going to deduct or take out the selling price for the salvage materials because that was a recovery of some of our costs. When you combine all those elements, then you have $65,000 for the capitalized cost of the land. Next is the building, the new building that they built. All right, so we're going to have the architect's fees. That relates to the new building. we'll have the construction cost brought in of $500,000. And then we're also going to add in the interest on the construction loan. All those together will give you $517,000 using my altered data as the cost of the building that will go on the books. Exercise number 2, which comes immediately after, on page 553, Oak Tree Company purchased new equipment and made the following expenditures. Well, we have the purchase price of, using my data, $46,000, sales tax, freight charges for shipment of the equipment, insurance. On the equipment during the first year, that would not be included, that would just be expensed as incurred. And then installation of the equipment, that would be included. So let's unpack this then, and let's consider what is really included in the cost of the equipment then. We'll have, of course, the purchase price. We're going to add in the sales tax and the freight charges and the installation of the equipment. All of these costs get rolled up and capitalized into the cost of the equipment. Right, then we know that we have accounts payable. I just put various because as a practical matter, we wouldn't normally throw all of these accounts into these payables into one accounts payable. For example, there might be a separate account for sales tax payable. But in any event, it goes into or credited to accounts payable, and that's going to include the amount that we owe, which is the purchase price of $46,000 using my numbers, and we'll add to that the sales tax. Price sales tax are added into the amount that we owe. The difference between the value of the equipment and the amount we're financing short term is the cash outlay of $1,700 using my numbers. I'd say the key on this one, exercise 10-2, is to make sure we bring in the right costs for the equipment. And as I listed before, that would include several items, including the purchase price, sales tax, freight, and then the installation of equipment charges. And don't forget that you did in this transaction pay for some insurance going forward. So that insurance would be expensed as used up throughout the term of the insurance contract. But at least at this point, we have a prepaid asset, so we have not had the benefit of any of the insurance protection at this point, and then we credit cash for the amount of the policy premium. To exercise 10-3, Samtec Manufacturing purchased land in a building for $4 million. We changed that to $4.1 million. And they list a variety of costs that were incurred, and those costs include title insurance, legal fees, prorated taxes after the acquisition, and state transfer fees. Value of the land I altered to $3.4 million. And so when you look then at the cost to be rolled up, and then you look at some additional assets, such as the parking lot, landscaping, which will be handled separately. There are a few things to unpack here. One of the things we need to do, and I would do this first, is to allocate the combined purchase price of $4.1 million in my case, and then we got to allocate based on their respective fair market values as we did earlier. Costs allocable to the land in percent and costs allocable to the building. Again, just to review, how did we determine this percentage that we're going to apply against the $4.1 million on behalf of the land? Well, we're going to take the fair value of the land and divide it by the combination of the fair value of the land and the fair value of the building. The denominator is the value of both items, and then in this case, the numerator is the fair value of the land. And since we only have two assets, I just took 1 minus 75.56%, or you could use the other method I described earlier and just went through for the land. And you will arrive then at the allocation based on fair market value of the respective assets. And it's these percentages that will be used and applied against the cost or amount paid for the combined and then building purchase. So we would apply, for example, for the initial valuation of the land, we would apply the total cost of the land and buildings times the percentage of 75.56%. One thing I want to add is that in the total cost of the land and buildings, in addition to the purchase price, you're going to add in the other items that relate to its cost, which we discussed earlier, like title insurance goes in there. Legal fees related to the purchase contract as well as state transfer fees. So that's why I created a separate line item for the total cost of land and buildings, because while we initially paid $4,100,000 using my numbers, it's true that we need to add in other items as well to the cost, because all of those costs will be added into what was paid for the property. So it's this amount here that will apply against the percentages that we calculated earlier. So 75.56% of $4,125,000 will give you the initial valuation of the land of $3,116,667. We'll do the same thing for the building. 24.44% times the total amount paid, including all the other fees, will give us $1,008,333. That's the first general step, is to allocate the total purchase cost plus all the other costs related to it, and calculate the percentage allocation based on fair market value, and then apply those percentages against the combined valuation. It includes everything. Once you do that, then you go down to the initial valuation of the parking lot and the landscaping. As a practical matter, these items would likely be broken up separately on the books because they have different lives. Often parking lots are depreciable and landscaping is not. But the authors just combine them into a land improvements account. It's just going to be a matter of adding together the two items, $82,000 and $40,000. Broke them out separately here because as a practical matter, that's kind of how they would be presented on the books. Okay, now part two changes things a little bit. Here we're going to demolish the old building. Well, if we demolish the old building under the second scenario for this exercise, then of course the building would have a zero value. It's gone. Now we're going to roll all of those costs less salvage value into the value of the land. I took then the valuations above, added together the initial value of the land, to that added cost to get the land ready for its intended use. I'll talk about that in a minute. And then I also added in the initial value of the building. To get my initial value of the land, I brought down the initial values from above. Then I added $330,000. This $330,000 is the $250 demolition costs minus the $6,000 recovery of salvaged materials. And then I added also in the clearing and grading cost to prepare the construction for the new building. I added then together the initial cost of the land, the initial cost of the building, and then the new costs less the salvage value for the value of the land. And nothing has changed regarding the land improvements. Exercise 10.9. A company purchased a new used tractor. Buyer paid $5,000 down and signed a non-interest-bearing note, $25,000. Fair value of the tractor was not determinable. An interest rate of 10% reflects the time value of money. So the first item is to prepare the journal entries. The only thing I changed here was I changed the discount rate to 11%. As I listed the values given, we have the down payment of $5,000, and the term of the note is 3 years. So we have a $25,000 note due in 3 years at 11% using my value. First thing we need to do is we need to calculate the present value of the note. And this, we've done similar examples in the past. I entered the rate at 11%, number of periods 3, and then the future value, the amount we have to pay in 3 years, is $25,000. That means that the value of the note today is $18,000 to my discount rate. The value of the tractor. Well, the value of the tractor would be the combination of the present value of the note, $18,280, plus the down payment of $5,000, would give us our cost for the tractor. And I just included things that we know already and were given. We know that we have a notes payable of $25,000 credit, and we lost cash of $5,000, so credit that asset. And then you can use the discount on notes payable as a plug figure, or you can also take the $25,000 term of the note less the discounted value of the note. Either approach leads you to the discount on notes payable, the contra account, which will be expensed over time throughout the term of the note. Number 2 asks us to calculate the interest expense included in 2021 and 2022. So the interest expense in this case is, I'm going to apply my 11% times my present value of the note, 18,280. So 11% times 18,280. So I essentially have multiplied these two values together. And that gave me the value of 2011 using my discount rate. And then now look at the interest in 2022. In this case, we have to add in the previous amortized interest expense to our initial present value of the note. So if the initial present value of the note is 18,280, we need to add in the previously recognized amount of the discount of 2011. Is that the sum of those two values that we will multiply times our 11%? The interest expense has increased. With the liability on the balance sheet, we know we have the 18,280. To that, we're going to add the interest expensed in 2021. So essentially we're going to add 18,280 plus 2011. That will be our liabilities going up, right? Because we want to eventually get up to 25,000 at the end of the term of 3 years. The liability reported in 2022, we can just take the last year's value and add to it the newly expensed interest in 2022 of 2,232. And that will update the value of this liability on the books to 22,523 using my numbers. By the time you get to the end of year 3, you will be up to the 25,000 and you'll pay off the note at that time. If you have any questions on these or any of the other problems or exercises or concepts and principles in the first part of Chapter 10, please let me know.